Always good to have you here.
Thanks, David.
We're continuing a conversation we started some time ago. We get bank earnings starting. I bet they'll get some questions on this. So is that $1.5 trillion over the next 3 years a so-called crisis?
Yeah, well, I mean, we have about $280 billion that is maturing this year. It's the largest amount that we've had. So this is this wall of maturities. And you think about most of these loans were done in an interest rate regime of near zero interest rates, and now need to refine themselves in a more normalized interest rate environment. And even, well underwritten loans are going to have a very hard time refinancing without new equity being placed in under that circumstance. And when we spoke the last time, I was talking about some concerns about liquidity in the market.
Yes.
And obviously, if the events of the last month with SVB and Signature and Credit Suisse, that just has made that much more pronounced. And so it went from a liquidity concern to, my opinion, really a credit crunch. There's just really very, very little credit in the market. Regional banks have tended to be the biggest lenders for commercial real estate, make about 40% of their books of business. And they pretty much have stopped, right? I mean, whether it's their boards telling them to slow down, shareholders they're concerned about, regulators they're concerned about.
It's hard to imagine they're going to re-underwrite something at, given the at least the economic fundamentals that are taking place in that market.
Yeah, but I think it's the economic fundamental, but I also just think it's their concentration risk. About 40% of their loans are commercial real estate, right? And regulators are very focused. You mentioned bank earnings, right? I'm sure the shareholders are going to be looking about what is their commercial real estate book when they start looking at earnings.
Commercial real estate's a lot of things, but my number for office loans, specifically office loans, which we've been very focused on given the lack of occupancy, is $80 billion in 2023.
That's correct.
So who does that? Who does them?
Yeah, so it's interesting. Office and retail, in many cases, is going through sort of this structural crisis, right? It's not limited to that, but on the office and retail side, and particularly office, there's no lender. The only lender is the existing lender, right? And that's a key thing to focus on is that you need to have situations where the existing lenders can work with borrowers, where borrowers that are willing to inject capital, recapitalize, adjust for the higher interest rate environment, go forward, and not just fire sale assets. And just at this point, though, because people are so focused on office, let's not forget that multifamily has been the most amount of transactions and the most amount of construction loans over the last 5 years. And now they're all starting to roll over, right? And that is one where I think, again, you're going to have a tremendous challenge because even if you were financed at 50%, 60%, you're not refinancing that loan at that same balance as you were before.
So, but let's come to sort of one of your bread and butters, something you know a lot about, New York City office buildings. I mean, we haven't seen a lot of deals. So where would things, if they do price, where would they price? What's the number going to be?
That's the challenge, right? I mean, in an illiquid market, you don't want to sell because it's going to be this exaggerated down number. And I think that's the big risk, frankly, that could make this systemic, right? If banks are forced to sell their loan book today, they're going to have numbers that are much lower than what they're marked. And then that is going to become this self-fulfilling cycle where everyone's going to have to remark their books. And that's where you really have a crisis that can be prevented.
All right, how?
So, I mean, I frame it this way. I call it sort of land and expand, right? The first thing is you got to avoid a hard landing. And that means you got to have the banks be encouraged and have policies where they can work with the borrowers that are able to work with them to do responsible recapitalizations, right? And they did that in 2009. They did that in 2020, changed the REMIC rules, a message from the top from the regulators, right, to just give room so there be some liquidity in the market and some price transparency to move forward. And then on the expand side, you got to expand credit. And there's really two ways that I could think of to do that. One is new loans done today are going to be the best loans anyone writes, right? Because they're underwriting in the current macro environment, so they see that. They're underwriting the current interest rates. They know what that's going to be. And they're underwriting with no competition, so they could be more conservative. So you should encourage banks to make new loans and don't bundle them when they look at commercial real estate, the legacy loans versus the new loans. And then the second thing on liquidity is, particularly on multifamily, we have the agencies, right, Fannie Mae and Freddie Mac, which have been very effective tools for multifamily. We should encourage them to double their capacity right now. So they help take those loans where there's illiquidity in the market and actually create some of that liquidity in that market.
Yeah, but I wonder, does any new equity come in? I mean, I noted yesterday, I'm sure you saw it, Blackstone closed a $30 billion real estate fund. I mean, what are they going to use that money for?
Right. Well, listen, there's a lot of capital out there. There's very little liquidity out there. And that's because there's such a fog of uncertainty around where things are going to be ultimately valued. We are actively making preferred equity investments and mezzanine investments. We have $1 billion of them we're working on right now, already closed $250 million. And it's the best investments you can make because we're making effectively loans, 60%, 65% loan to today's value, getting a 9% current return, 15+% total return I couldn't get that on equity when I was making equity risk returns right now, right? So this is a period where if you have clarity and conviction, you want to back up the truck and try to make those types of
Are there
loans.
any particular classes of real estate, though, that you think are going to outperform or perform best over the next 3 years?